Hi, everyone. Welcome to another Actuaries Summit session. So my name is Simone Collins. I'd like to start out by acknowledging the traditional owners of the lands across Australia and New Zealand on which we're gathered and pay my respects to elders past, present and emerging. So today we've got an exciting session and hopefully a very relevant session. So I'll introduce you to our speaker, Richard Hartigan. Now, thank you, Richard, for getting up very early because Richard is based in London. So it's crack of dawn over there in the morning at the moment. So Richard is a general insurance actuary working in London. He graduated from Macquarie University in 1992 and completed an MBA with distinction at Cornell University's Johnson School in 2003. He's a member of both the UK Institute as a fellow and a fellow of the Australian Actuaries Institute as well. So with that, I will hand over to you, Richard.
Thank you very much, Simone. I'm going to go ahead and share my screen. Let me know if it's successful. Is that successful?
You can hear us.
Wonderful. Thank you very much for joining me today. Good afternoon, Australia, and good morning, London and the rest of the world. Today I'm going to talk about a grant proposal for uninsurable risks, and the sort of the genesis of this talk was here in the UK. I'm sure most people are aware, as a result of the pandemic we're currently experiencing, there was some business interruption claims that were contested between the insurers and the insureds, and I got to thinking that this wasn't a very good outcome. So I thought, what can we do about it, essentially? So what I wanted to do is start off talking about what this presentation is about, and that's the shared interest in insurance of the three principal parties, and that's the insured, the insurer, and the government. And what I'm talking about today is principally first-party property coverages. And I want to acknowledge right from the start that what I'm doing is planting a seed of a relatively immature idea, and I'm hoping to crowdsource some ideas from improvements from those watching today. I also want to talk about what this presentation is not about, and it's not about cross-subsidization or selling insurance at below risk rates. That's not at all what it's about. It's also not about getting the government involved in the business or pricing of insurance. In fact, at the margin, this idea should slightly decrease that. My sense is that, if possible, insurance should remain in the private sphere, relatively free of direct government involvement. The presentation or the idea is also not about disturbing or warping natural insurance competition. As we'll see later in the presentation, competition is a very significant element of this idea and very important as well. It's also not forcing anything onto the insured that they don't want. What you'll see throughout this presentation and the idea as it's presented is there's a degree of optionality of sort of, opting in or opting out. And it's also not about increasing the risk to the insurer. At the margin, quite the opposite, actually. I just want to say a note right there at the bottom, sort of as an aside, really, and we'll talk about this a little bit later. And that's that the presentation, the idea, does not solve the affordability problem. I know this is a topic of interest in Australia just in the last couple of days and on an ongoing basis, particularly in Northern Australia. So this idea does not solve that problem per se, but it may alleviate that problem. So we'll talk more about that later. Right at the start, I said, the genesis of this idea was observing what happened in the UK with respect to the business interruption insurance arguments, I guess, between insured and insurer. And then the government, via the FCA, the Financial Conduct Authority, got involved and sort of stood in for the insureds in the court cases that followed, largely successfully. And that's the three parties have a shared interest in getting insurance right. It's actually in the interests of all parties to sort of create an environment that works for all parties. And we'll talk about that just now. So we'll start by looking at, this is pretty fundamental, but sort of stepping back a minute and sort of thinking about, what is the insured's interest in insurance? And pretty fundamentally, it's that they just want to protect their balance sheet, and their personal balance sheet in this context is their house, their car, or their business. Insurance allows the insured to bounce back after fortuitous loss. What's the insurer's interest in insurance? Well, that's a lot simpler, of course. Most insurers are for profit, and most are profit seeking. Most usually make a profit, which is a good thing. And then you have the government's interest in insurance. And this is sort of less understood or less considered, I think, in the broader sense, and something that's important to me. And one thing that's sort of often forgotten is that insurance is oil that lubricates the entire economy. The government has a very strong interest in fostering a healthy, fair, and competitive insurance industry as good public policy. And a lot of what we're going to talk about today sort of has its genesis in that good public policy idea, creating something, a public good, if you like, that is a good insurance industry, or an insurance industry that works for all. The government, of course, also sets prudential standards for insurers to ensure or minimize the risk that they go insolvent, and conduct standards, which we call here in the UK treating customers fairly. But that's essentially, creating an environment where the insurer is encouraged to engage with the insureds in a fair and reasonable manner. So let's talk about some typical exclusions, and this is non-exhaustive, obviously. Some of the more typical ones, particularly recently, are pandemic or anything related to pandemic. We see that specifically with respect to business interruption, but also with travel insurance, cancellation insurance, contingency, many other different types of insurance. Terrorism has been, in the past, an exclusion. It's an ongoing exclusion in many policies. Flood, I know, is less of an exclusion today than it was historically in Australia, but when I lived in Australia some years ago, flood was typically excluded for domestic or residential household policies. Cyber is often an exclusion, and then we have the more typical exclusions, war and nuclear. Obviously, this list is not exhaustive. We can add any number of either perils or loss-specific circumstances which might result in an exclusion of a fortuitous loss. And the difficulty, of course, is that if the insured is primarily interested in protecting their balance sheet, and I think they might be, how or which fortuitous loss impacts their balance sheet is of very little interest to them. They just don't care. If the fortuitous loss occurs, the insured has an immediate need, which is to repair their balance sheet. And, as insureds, when we think about designing a policy, if we're sort of all about trying to exclude things, this often gets lost in the mix. And I think that's something really important to consider. Maybe put yourself in the insured's shoes, and sort of work out how you would feel if the insurance you purchased did not respond. Naturally you would feel or view insurance as a poor value product. And the poor value, or the view of insurance as poor value, serves neither the insurer nor the government. Clearly, it doesn't serve the insured either. And this poor value is not getting insurance right. Something's wrong, basically. So the most obvious alternative is to have a policy with no exclusions. And you can see in the first note at the bottom of the page, the optionality here. I'm not saying that the insurer must offer a policy with no exclusion. I'm saying that they may offer a policy with no exclusions as one element of their library of policies that they may or may not offer. But of course, to do that, there must be some quid pro quo for the insurer. And what I propose, or the idea suggests, is that if a collective event loss, a catastrophe if you like, is large enough that the insurer is legally permitted to pay out less than 100% of the claim, of each insured's claim. So obviously a collective event loss involves multiple insureds, each of whom have a claim. And the idea is if the claim collectively reaches a certain level, that the insurer is able to pay out sub 100% of the claim. Now, how we achieve this is a matter of discussion or debate today. I'm hoping I might get some views at the end of the presentation. But one way is through sort of robust and clear policy language so that the insured knows upfront that this is a possibility if a large collective event loss does occur. Or it may be that primary legislation by the government is needed to support this idea, this initiative. And the other thing I want to note just at the very bottom of the page, and the second note at the bottom of the page, is that the idea does not rely on an insurer's reinsurers to follow suit. It's completely independent. So it would be good if we could get reinsurers to follow suit, but of course that would not be typical, particularly at the moment, actually. So first of all, let's look at what the benefits might be of such an idea to each of the three parties. And we'll start with the insured. And the most obvious benefit is that the insured knows that in all fortuitous loss circumstances, their balance sheet is protected. They know that occasionally, if a very large collective event loss occurred, the insurer would pay out less than 100% of their claim. But of course, the alternative for many perils, exclusions, is that no cover at all is offered. So this is a net positive for the insured. And the other net positive is, as long as the loss is demonstrably a fortuitous loss, there'll be no squabbles. There'll be no need to go to court to enforce the contract, no need to get lawyers involved or regulators, as the case was here in the UK recently. We next look to the benefits to the insurer. So if a large collective event loss did occur and the insurer was legally permitted to pay out sub 100% of the insurer's claims, that would strengthen the insurer from a prudential point of view because the tail risk, the cat risk, if you like, is reduced. The risk posed by black swans, so in the UK, the example would be pandemic followed by business interruption losses, is eliminated. The insurer does pay for black swans, but their exposure is capped, and we'll look at that a little bit later on. There's actually a net positive to the insurer as well, not to get involved in squabbles with their insureds. Many of the insurers in the UK, for example, that got involved with the case, business interruption case, were left with much poorer reputations, hard-built reputations for treating their customers fairly and for paying out on losses that should have been covered according to the court anyway. The other thing that's a positive to the whole insurance industry is that insurance is actually lifted to being seen as a product of good value. I think, you know, net, maybe the insurance industry as a whole collectively I think there's a general acknowledgement that insurance is not generally seen as a positive product, being one that one must buy rather than one wants to buy. But part of that is, I think, the perception of lack of good value. And then because of the increased perception of good value, there should be a higher take-up of insurance by insureds, which should result in more profit to the insurer. Then we'll look at the third party, the benefit. Once again, there's a huge benefit to the government to insurance being lifted to be a product of good value. It's good public policy, mainly because there's a higher take-up by insureds of insurance and lower numbers of uninsured. We see, unfortunately, after every catastrophe, large numbers of people who have no insurance and are left with a very limited ability to rebuild their balance sheet when their house is swept away or their business is interrupted. Insurers are also strengthened from a prudential point of view. Obviously, this is a positive to the government. When the large collective event loss occurs, there's a release valve, which is effectively co-insurance back to the insureds. And then the government also has an interest in the conduct of insurers towards their insured. And that should improve because a significant friction point, which is squabbles over fortuitous losses that the insurer asserts are excluded claims, is removed. So as you can see, all parties benefit from this idea. Now, by now, I'm sure there's a few skeptics in the audience. So I just wanted to take a little one-slide detour of a similar idea in a very different context. So there's something, it's just about to happen in the UK, actually, something called collective defined contribution plans. And essentially, it's a hybrid between a defined benefit and a defined contribution plan. And the reason on the top left there, you see the Royal Mail postbox, is that it's widely believed that Royal Mail will be the first CDC. The legislation allowing CDCs was only brought, it was only a month or two ago, was brought into being. And regulations are currently being set by the regulator, and Royal Mail is widely believed to be primed and ready to go. And the basic mechanics of the plan are defined benefit, as we all know it as actuaries, perhaps more the older actuaries than the younger actuaries. But the employer only commits to paying a fixed percentage contribution. Now, that fixed percentage contribution is, at the outset, expected to be adequate to cover the forecast benefits under the defined benefit plan, or the CDC plan, I should say. But of course, circumstances intervene. So should the plan subsequently go into deficit, then benefits are scaled back. Should the plan subsequently go into surplus, benefits may be increased. The employer contribution always remains fixed. Now, here at the bottom is the sort of the segue into the idea I'm discussing today. The alternative for employees is a defined contribution scheme, which apparently Royal Mail employees do not want. The alternative for the idea I've laid out today thus far, and will continue to do so, is that perils will simply not be covered. Pandemic would be an excluded peril. So the segue between the two ideas is there's a sensible trade-off, to achieve a higher good. So let's look relatively briefly at how this idea would work in practice. And for example purposes, just for example purposes, I'll assume flood is an excluded peril. So homeowner A, who lives on the top of the mountain, pays a premium for his or her all risks X flood homeowner property cover of $100. And homeowner B, who lives on the floodplain, pays the same premium. The perils X flood are identical. Now, through legislative support, the government has thought this idea I'm presenting today is a good idea, and they've provided legislative support that permits insurers to offer a policy which does exactly what I've laid out earlier today. And that's where a collective flood event loss to the insurer is greater than X, that the insurer's maximum liability to all insureds is X. There's no change whatsoever to any of the other perils, just flood in this circumstance. Now, of course, homeowner A at the top of the mountain, the prospect of a flood is relatively limited, so their premium goes from $100 to $101. Homeowner B, on the other hand, who lives on a floodplain, clearly prone to flood peril, their premium for their all-risk cover goes from $100 to $250, I should say. And we'll note at the bottom there that I spoke earlier about the affordability problem, and that this idea does not solve the affordability problem per se, but should be alleviated. And the reason it's alleviated is because the tail risk to the insurer and or the reinsurer profit needed to eliminate that tail risk to the insurer are both eliminated. So the next question is, how would we go about setting X? And my proposal today is to set it on a gross basis, pre-reinsurance basis to the insurer. And the main reason to do that is to do otherwise would encourage the insurer not to buy reinsurance when it would be otherwise be prudent. So try and push as much risk back onto the insureds collectively as they can. And to my mind, that would not be good public policy. So for perils where reinsurance is available, X would be set at the exhaustion point of the reinsurance program. For perils where reinsurance is unavailable, flood in the example I just, sorry, not flood, any other peril, pandemic, let's take as an example, X would be set at some prudent point by reference to the insurer's balance sheet. And just the note at the bottom there, I'm sort of operating on a per event, per peril basis for this idea or this presentation today. But it is entirely possible that X could be set in the aggregate, for a given period across all perils. So let's try and put some hard numbers next to this. There's a slightly different example here. And we know the reinsurance market freely offers earthquake and windstorm coverage, but no other perils. For this particular insurer, a 1 in 200 earthquake is $450 million, and the insurer does purchase reinsurance up to that level. For windstorm, the 1 in 200 year windstorm is $300 million. And once again, the insurer buys reinsurance up to that level. So the prudent insurer buys the available reinsurance to the level that is prudent. But of course, flood in this example and all other perils are not covered or not coverable by reinsurance. And so therefore all those losses would fall back to the insurer's balance sheet. And so I've made up this number arbitrarily, just for example purposes, but by reference to the insurer's balance sheet, a much smaller figure obviously would be a prudent point to impose this idea via co-insurance to the insureds, given that, for example, in this example, flood would otherwise be an excluded peril, and I've made that $22 million for example purposes today. So we have three different X at the bottom there. X for earthquake is 450, X for windstorm is 300, and X for any other peril, or all other perils, I should say, is $22 million. And what's important is that these figures are defined in advance in the policy language. These are not surprises to the insured. And that's very important to set expectations and to sort of maintain that idea that insurance is a good product. No one likes surprises. If the insured knows up front that an earthquake greater than 450, if they suffer a loss, might result in some scaling back of their claim, they'll understand that if it's up front. Likewise with flood in this particular example. If it's higher than 22 million, there's a collective loss to the insurer. But we've been talking about, one given insurer, insurer Y, I'll call them. But what about their competitor, insurer Z? Naturally, insurer Z's various X's will be different. But once again, the insureds of insurer Z will know up front that the X points, if you like, of insurer Z are different to the X points of insurer Y. And it's quite obvious that smaller insurers will naturally have smaller X's. So what we'll need to do is sort of develop some metric to allow informed choice by potential insureds. And no doubt Sunday newspaper or some whizzy website, consumer-orientated website will be developed to fill the void, to advise potential insureds. And it may be that sort of some regulatory oversight, both prudential and conduct, will also assist in this regard. And I spoke at the very beginning of this presentation about competition and the importance of competition. And wherever X is set, obviously that's a slight negative to the insurers, in the sense that if a collective event loss exceeds X, then their losses are scaled back. So the higher X's, I believe, over time will become a point of competition. Insurer Y and Insurer Z at the top of the page will compete to have higher X in order to attract more business. So I've presented all the positives, but there are some challenges to this idea. Would legislative support be required? I think quite probably that would be required. Could all the various X's for the various perils and the various insurers bamboozle potential insureds? Again, that's quite possibly an outcome of this idea. Additionally, are there challenges to setting X's on a calendar year basis when most policies misalign to the calendar year? The answer is yes, obviously, but I think that could be relatively reasonably solved and accommodated by regulatory oversight. For a growing insurer, X should always be growing. So it could be that in the latter part of an insured's policy period, that X would actually rise, and obviously that would be a net benefit to the insured. And it's probably the last dot point is probably the biggest challenge, actually. Yeah, could uncertainty over the quantum of the ultimate collective loss, event loss, or otherwise known as slow claims development, be an impediment? And absolutely that could be an impediment. If the insurer cannot accurately forecast the quantum of the ultimate collective event loss, then they don't know what percent of each individual loss to pay out. But this could be alleviated by interim part payments. So if, for example, the tentative forecast by the insurer is that they would pay 80 cents on the dollar for a given collective event loss, they might, as an interim part payment, pay 50% on the dollar today and then 10% over the next 3 to 6 months, 10% per month over the next 3 to 6 months. So we move on to the questions and comments sections, and I just want to sort of conclude a little bit here. The various X's would only be set to be used relatively infrequently. Hopefully, in the example of a peril which is covered by reinsurance, windstorm and earthquake in my earlier example, the prospect of an insurer exhausting their reinsurance program should be quite limited. Then we have other perils, flood, and some of the more obvious excluded perils, which essentially, black swans or grey swans, or I've seen any other number of terminology for these types of events, things that basically don't happen very often. The idea I presented today should not be used in practice to scale back individual insured's losses in the event of a collective event loss very often. It should be actually very infrequent. The second dot point I want to repeat, this is an idea to sort of create a sensible trade-off to achieve a higher good, a higher good that is acceptable to all three parties, the insured, the insurer, and the government. The alternative, of course, for many perils that would otherwise be excluded is that no cover at all is offered. So it seems to me that there's a relatively low downside to this idea if we can get the mechanics working. And then once again, I just want to solicit help. This presentation was about planting a seed of an immature idea and crowdsourcing ideas for improvements. So I'm hoping there might be some questions and comments now. Thank you very much for listening.
Great. Thank you very much, Richard. I'm sure that there will be some thoughts provoked here with the audience. So we've had a few questions come through. I'll just read them out so that we make sure that we have them for the recording. So we've got one from David Minty, who said that one problem might be after the event occurs, when neighbours are insured with different insurers and hence receive back different percentage of their loss. So there might be a pressure to increase the payment percentage, and the ultimate payout will be unknowable to insureds in advance since they need to know the total sums insured the insurer has written. So hopefully solvable and might need government support in the short term. But do you have any thoughts on those particular issues?
I do, and thank you very much, David, for asking the question, or series of questions. In regards to the first part, I think, it's the way different insurers respond to a given event is different. So, for example, even today, if an earthquake occurred, insurer X and insurer Y would respond to two different neighbors in a very different way. So given, obviously in the idea I've presented, there would be, say, for example, 75% payout for one insurer and 80% for another insurer. But it's very likely that, ignoring this idea, that the two insurers would respond to their two different insurers in a very different way anyway. It just wouldn't be quite so black and white, I guess, in the sense that I'm sure the Sunday newspapers would report that insurer X had paid 75%, insurer Y had paid 80%, and therefore insurer X was bad. There might be a need to manage that message. You're quite right that there might, in that circumstance, be pressure to increase a payout, and it might be that on an ex gratia basis, that insurer X, in the example I just gave, would increase the payment to 80%, for example. And that would all be wrapped up in the sort of the idea of competition, which underpins much of this idea. I spoke earlier about the ultimate payout being unknowable to the insureds in advance. Yes, that's the slow claims development issue I spoke about towards the end there. And I think government support for this idea would be essential. I gave one option of insurance policy language incorporating this idea. My sense is that that would not be strong enough to get the idea off the ground. It would require some level of government support, probably via legislation.
Great, thank you. And we have one from Joseph Honglu, who's said, on your comment of bamboozlement, the insured typically has an idea of the trade-off when picking a higher deductible for a lower premium, but how are they expected to understand this trade-off when considering the upper X threshold versus the premium and considering the competitive choices there?
So thank you very much, Joseph, for your question. So the way I see it is that there would be third parties, and the examples I gave were a consumer-orientated website, or perhaps a Sunday newspaper, or perhaps the regulator directly, providing some sort of information that would allow potential insureds to educate themselves, for want of a better word, as to the pros and cons of insurer X versus insurer Y. That's particularly important because obviously different insurers are very different sizes. The largest insurers in Australia are very, very large, but there's a number of smaller insurers as well. If the insureds just looked at the X in dollar terms, then obviously that might be especially favorable to the larger insurers and create a concentration of risk in those larger insureds, all other things being equal, which obviously would be terrible public policy. So we need to collectively nut out an idea as to how the insureds, could get a better idea about, the differences between insurer X and insurer Y and their various X dollar, points of exhaustion. I would welcome ideas as to how to do that in practice.
What role do you think the catastrophe modelling firms have to play in that? Because you've said the smaller companies of $1X. So if you're looking at more of a probability of sufficiency type measure, but then something standardized potentially across the industry so that the smaller players aren't disadvantaged compared to the larger ones.
Yeah, so there's two elements to the idea, and that's perils that are covered by reinsurance, so earthquake and windstorm in the example I gave, and there would be a significant role, I think, for the CAT modelers in those two circumstances, because of course the output of their models forms the reinsurance strategy of insurers and the exhaustion point to which the insurers buy to, and typically in the example I gave today anyway, the ID would only attach above that exhaustion, or the X for those particular perils would be above that exhaustion point. For Non-covered perils, flood in the example I gave today, there is probably less of a direct role for the cat modelers to play, and more of a direct role probably for the government to play, actually, because the retention on non-reinsured losses should be directly connected to the strength of an individual insurer, to their balance sheet, essentially, the insurer's balance sheet, because all the losses would be retained net. So yeah, cat modelers for covered perils and regulators for non-covered perils.
Okay, and along the same lines, so Stephen Lom's commented, would $1 for the entire industry be more acceptable and easier to understand for the public, which implies a sort of central body or pool might be needed to monitor and manage this?
Yes, I mean, absolutely, Stephen, that would definitely be the case. But then, how that X for the entire industry is split up between X would be, I think, add a layer of complexity, particularly with the slow claims development problem. I mean, it's an idea, it's an excellent idea, and it's one that should be considered as part of the broader idea that I've presented today. It's not one that I personally favour.
Okay, thank you. And we've got a couple of comments around the terrorism pool. So Guy Thorburn, I think what you're describing is a feature of the terrorist reinsurance pool in Australia. In this scheme, the government may declare a reduction percentage if the scheme's capacity is exceeded. This was put in place for an uninsurable risk at the time, might be a place to look for ideas. And David Minty has also commented, sounds like the terrorism pool might be a starting point in Oz, and also noting the announcement yesterday or the day before around potentially a cyclone pool in northern Queensland as well. So do you have any comments on these pooling arrangements and thoughts on how they may or may not assist with the idea?
So Guy and David, thank you very much for bringing this to my attention. I was not aware of that, so I will take the time to look into that in the next few days. As regards the government's cyclone reinsurance backstop, and I think there was also a national recovery and resilience agency announced in the last few days. I do have some thoughts on those two things, actually, and that's, first of all, there's relatively limited information available for both those two initiatives. Detail is exceptionally light. So, I'm not saying that those ideas will not be successful, but the information we currently have to hand doesn't allow us to make any judgment whatsoever as to their likelihood of success or not. The other thing I would note is I think it's $600 million going to this national recovery and resilience agency. First of all, $600 million is not very much. And I do note too that this agency is a merger of two existing agencies. So I do wonder how much of that $600 million is new money. Maybe one of the audience can help me out there. The other thing with respect to particularly the backstop is it seems to be peril-specific, so cyclone and to a lesser extent flood, and it seems to be very geographically specific as well. So the problem with government, well, my observation anyway, the problem with government getting involved in insurance is it's sort of on a pick and choose basis. So it's the terrorism pool, for example, or in this particular case, the cyclone pool that proposed for Northern Australia. We have other examples around the world, the terrorism pools variously around the world, the NFIP in the US, for example. This idea of government cherry picking or getting involved in relatively limited niches within the insurance sector does not seem to me to be particularly efficient. So I'm not a fan of the government's proposals of the last few days just for that reason alone, actually. The other thing is, in my mind, these types of backstops, so I'll switch back to this $10 billion cyclone backstop for Northern Australia, tend to work best when there's a sort of a total collapse of the insurance market, sort of a complete unavailability of cover. I'm sure many in the audience will know much better than I do, but that does not appear to me to be the case here. It seems to be more the case that there's a perception that cover is too expensive, the affordability problem. And I do worry when governments get involved to try and solve the affordability problem, because to me that's sort of a red rag to a bull to sort of underprice risk. And given it's the taxpayer ultimately that covers that risk, there's a sort of a transfer of wealth from the southern part of Australia to the northern part of Australia in that particular example. I would give as a grand example of this the NFIP in the US, where certain southern states, Mississippi, Louisiana, to a lesser extent Alabama, are massively cross-subsidized with some of the northeastern and western states of the US. And to me, that's just not good public policy. It encourages the opposite of what governments should be encouraging, and that's better resilience of properties in those exposed areas and lower rates of building or new building in those areas. So I'm not at all a fan of the government's proposals of the last few days. I'm sorry, that was a bit long-winded.
No, that's great. Thanks, Rachel. So I think I'm a bit there, so I hope everyone can still hear me all right. So along similar lines, Robert Cole has commented that the Japanese earthquake pool might be an interesting one to look at, as it has capping mechanisms as well as sharing, and the EQC in New Zealand for the insurer's land. Are you familiar with those schemes, and do you have any comments or thoughts on how they operate there?
So thank you very much, Robert. I am familiar with the EQC. I am not familiar with the Japanese earthquake pool. My observation is the EQC in New Zealand is precisely what I just described, the government stepping in where otherwise there might not be any coverage. So I would hold up the EQC as an example of a positive example of a government involvement in insurance, albeit one that's obviously very specifically peril orientated.
Thank you. And Robert's also questioned if you've considered a parametric approach and whether this could be used as an alternative to indemnity. So having benefit levels that are fixed could be set deliberately below the customer's loss.
So my sense is that the involvement of the parametric idea in insurance exists principally to allow insurance to be syndicated out to non-insurance parties, to the wider financial community via a cat bond, for example. And that's not necessarily a bad thing. For perils or potential losses that exceed the capacity of the global insurance industry, that's obviously a really, really good thing. But my sense is that it's only in that circumstances that a parametric approach would be a positive for the insurance industry as a whole, and in no other circumstances. So I guess to rule a line under my thought, I'm not a very big fan of parametric approaches, but they do have their place.
Great, thank you. We've also got a comment from David Minty that the industry X figure that we were speaking about before also sounds like a reinsurance pool for, I'm assuming that's health insurance. Are you familiar with the reinsurance pool there to make any comments?
I'm not. And if David could just clarify, is this for Australia or for somewhere else? I was not at all aware that there's a reinsurance pool anywhere in the world for health insurance.
All right, we might park that one and see if David can come back to us with more details on that one. We've also had a comment from Juliet Denmark. Are we leaving the lower socioeconomic groups behind again? Correct me if I'm wrong, but I thought that large components of the low-lying areas affected by the Brisbane floods were the lower socioeconomic groups. So it would be the same groups who need and rely on insurance coverage more that don't receive their full value in a large event. Do you have any thoughts on that one?
So there's a couple of strands to this. Firstly, if flood was otherwise an excluded peril, I'm assuming it was not in this particular circumstance. But if it was an otherwise excluded peril, then getting 70 cents on the dollar is better than getting 0% on the dollar. So that's idea number one. Idea number two is if flood is a covered peril, then yes, there's a possibility that if reinsurance is available for flood, that is, and I'm assuming it is in the example, that there might be a lower than 100 cents on the dollar payout. and in the sense that it impacts, in this particular example, lower socioeconomic groups. In the same way, it impacts higher socioeconomic groups. They both get 70 or 80 cents on the dollar. Then yes, it might have a proportionally higher penalty on lower socioeconomic groups. I see that as a sort of broader public policy issue that would need to perhaps be addressed alongside this idea I presented today. If I'm being totally honest, Juliet, I hadn't considered that at all, but I will give that some more thought. Thank you very much.
Great, thank you. And we've just got clarification from David Minty on the previous question. So Australian health insurers must share claims costs of over 65. So that's the pooling mechanism that he was referring to there.
Thank you, David. I was not aware of that.
Okay, great. And another one from Juliet, going back to one of the slides in your presentation. So although it's about GI, Juliet's interested in the super fund example, and would that potentially result in generational cross subsidies, and whether that's also relevant to maybe this GI proposal that you have?
So I'm assuming you're talking about the CDC example I gave in the presentation, Juliet. No, I don't. So first of all, the employer's contribution to a CDC is set initially such that it is expected to be adequate. So it may or may not be, obviously, as circumstances evolve. I don't see that it's obvious that there might be generational cross subsidies in that particular example. So maybe I missed the point of your question. I apologize for that. With respect to GI, I think this is more your question, Simone. Would there be any subsidies in my idea? I mean, to a relatively limited extent, the subsidies is back to the insurer in the sense that, if a loss is above a certain level, obviously the co-insurance idea kicks in. And the quid pro quo, of course, is that the insurer offers a product which covers all perils, where otherwise they might not otherwise do that. So I thought very carefully about what the motivation might be for the insurer to offer an all perils cover, and there has to be some quid pro quo. And to me, that seemed like the one that was of greatest value to the insurer, but of least penalty to the insured.
Great, thank you. And we'll see if any more questions come through, but just in the meantime, what do you see as kind of the next steps with this, and where do you see actuaries playing a role in trying to solve what is a very large scale problem?
Yeah, I mean, it is a large scale problem. I think it's the conversation I think we have to have is what is insurance? It's a sort of almost a philosophical conversation. If we're not, as an industry, creating a product that is seen as good value by the consumers of that product, then I think we all need to take a look at ourselves and work out why and try and solve the problem. This is just one idea. There's probably a dozen other ideas that are equally valid out there. But making the product better, but at the same time, obviously not increasing risk on the insurance industry as a whole, because that would be, sort of shooting yourself in the foot, I think is an imperative. And I think it's about conversations amongst the actuarial community with the insurance executive community, and to the extent that it's possible, governments or government people who are involved in insurance as well, because sort of building a better product is to everyone's advantage. And, that should be the stretch goal.
Okay, and where do you see conversations with the consumers fitting in here? Because my personal point of view is the average person really doesn't understand insurance and what they're purchasing. So they might not even be aware that these exclusions exist in the first place, let alone trying to get them to understand the concept of a reduced payout if the insurer suffers a certain loss, which is probably incomprehensible to the insured. So how do you see those conversations needing to happen to understand at that real grassroots level whether consumers would buy into the idea?
So I think consumers probably have no idea about specific exclusions on their policy until they're unfortunately hit by one of those exclusions when they go to claim. But I think they are quite aware that there are exclusions on insurance policies, because everyone's heard of an example of a neighbour or an uncle who's had their insurance claim denied for one reason or another. So I think if the conversation evolves as like this to the consumer, I think that would be a positive thing. Mr. or Mrs. Consumer, that your current insurance policy has exclusion. Doesn't really matter which ones they are. You don't know, and we don't need to really discuss it. But here I have a new type of insurance policy which has no exclusions. I think you wouldn't need to have a conversation any longer or broader than that. Any consumer understands that something with no exclusions are better than something with exclusions, even if they don't know which exclusions they currently have. That's the thinking I have on that particular question.
Mm-hmm. Okay, great. And Juliet has just clarified her earlier question. So if members leave when it appears fully funded, they receive their full amount. If 10 years later underfunding becomes evident, then the future retirees don't receive full benefits. So that's relating back to your superannuation example that you had.
So given the idea of a CDC, or the possible creation of a CDC, is very new in the UK. It's only a month or two old, and currently there are none. The Royal Mail is trying to establish a CDC. I'm not sure what happens to those who have retired and then then the fund subsequently goes into deficit. I suspect that even those who have retired would have to take a benefit cut post retirement. So, for example, if they received $100 a week from the defined benefit fund the CDC, and the CDC went into deficit, they might get a cut to say $97 a week, for example. That's how I imagine things work with the CDC, but we've not actually seen any of them in practice. It would largely depend on that.
Okay. Great, thank you. And just on the implementation side, David Minty has commented, it's good to try and get a single system that covers all types of peril. You can then look to integrate that with government support. Hopefully it can be managed, but overall a great idea, thanks.
Thank you, David.
And I think, unless I'll maybe wait 20 more seconds to see if any other comments or questions come through, but otherwise I think that's all of them that we've gone through there. But yeah, overall, I think very thought-provoking, big problem to try and tackle. So I think lots of discussions to be had within actuaries and with consumers, governments, all of the stakeholders need to be involved there. So yeah, I think we're all quiet on the comments front. So everyone, please rate the session, and I don't know if you can, round of applause in your own private homes, but join me in thanking Richard, and especially for getting up very early to do his presentation again. So thank you very much, Richard. It was very interesting, and well done.
Thank you, Simone.